Welcome to the Dividend Talk podcast, episode 238. The stock market's long-awaited correction is right here.
By the way, let's get started straight away. What was the most interesting thing in the in the news this week?
So Intel, one of our, well, I wouldn't say favorite companies, but a company that's very dear to Dividend Talk. We used to have Dividend Day, especially for Intel, because they dropped 9% nearly like clockwork every single time they released earnings. But they have a new CEO. Lip Bu Tan is the new CEO of it, and the market seemed to react quite positively to this change.
Yeah, I mean, I guess anything else than the guy praying to the Lord each day is an improvement, right? Took them quite a while, but actually the price shot up 15% on the news. So talk about how to enter a new company, right?
Yeah, but I don't. I know that name, Cadence Design Systems, from somewhere, and I can't figure out from where. I know it's one of these names that just stick with you. But I checked their share price just as I seen this news article, and it grew from $13 or something from the time it was in charge up to $235 or something in that range. I mean, that's quite a jump. So maybe people are waiting for that to happen to Intel now that he's on board.
Yeah, well, one is praying for sure, Pat Gelsinger, because he must have still a lot of shares in Intel. I mean, Intel really lost it, right? One of those mistakes for me, like which I thought was value, but became a value trap. And where you were a little bit wiser, I thought with the ASML machines, they still have this thinking. But, at a certain moment, enough is enough.
Yeah. It's hard to watch when you see how much market share they were losing, seeing how well Nvidia did compared to Intel. Because Nvidia had Intel had the advantage for years and years, and they just never used it. And it's quite frustrating to look back and see. But I still have hopes for Intel. I mean, it's still a strong company, still generates a lot of free cash flow, but man, they're just so far behind. It's difficult to.
It's painful to watch. It's really painful. I mean, such an iconic company. How they screwed up under Bob Swan.
Yeah,
unbelievable.
Bob Swan really did damage that.
Yeah.
So, but look, let's see what the new CEO does. I mean, as you said, comes with a good reputation. The stock market reacted quite positively to it. So a lot of pressure to jump in, but a long road ahead, I think.
When you think about it was already written in the stars, right? Imagine you have a CEO called B. Swan. I mean, we could have known, right? Black Swan, Bob Swan. I mean, anyway.
Yeah, I'm pretty sure we talked about that when we spoke about Intel going down to Swanee. Remember that episode?
Yeah, exactly. Yeah, that was still a time that we made fool of CEOs.
Yeah, and you used to write to him on Twitter or tag him in Twitter.
Yeah, the good old days.
Yeah,
but honestly, actually, that was not the news that I was looking for, Derek. There was more news this week.
Go on.
You really forgot about it? It had not to do with Trump and the tariffs.
What is it?
Liverpool, PSG. How do you feel about it?
That never happened.
Oh, come on.
Do you know what? PSG were the better team over two legs. They 100% deserve to go through. When we won over in Paris, it was the biggest robbery I've seen in a long time. I've no hard feelings towards
the match was good, right? The second match.
Match was very good, but I honestly think that PSG versus Real Madrid will be a better match. That will be a good game. That will be a good game.
I mean, to the credit of Liverpool, I mean, losing from PSG it can happen. Yeah, I know they wanted to win the Champions League. They had good form already the whole year. But, they didn't lose from a B team somewhere in Greece or something like that. Yeah, this was like one of the top 4 teams in Europe.
Yeah, I think so. And Luis Enrique is a fantastic manager. So.
Yeah.
So let's see. I want someone else to win it rather than Real Madrid this year.
Yes, of course. But speaking about football, I just want to give a shout out to Jörg Reurings. Have you seen what he posted on about football on Facebook, on our Facebook group?
No.
He made a lineup for his portfolio. He called it Dividend United, and it's really nice. And I will run you through it. Who do you think? Which ticker do you think is in the goal?
Oh, you need a safe company in the goal. I'm going to go Johnson Johnson, AAA balance sheet.
No, in this case, there was the only ETF in here, TDIV, the Vanek Dividend Leaders one. Who do you think are in the defense? Let's say 5 defenders. He's playing 5-3-2.
I'm going to go Ahold Delhaize,
Yes.
Coca-Cola.
No.
I'm going to go with Microsoft. No, Microsoft
No.
in defense. We're looking for maybe Target.
No.
I'm far off the mark then. Come
Okay.
on, put me out of my misery.
So Ahold, Realty Income,
Yeah.
Shell,
Okay.
ASR, and AppFi.
Oh, okay.
What do you think are in the midfield?
Midfielders, you want a bit more creativity. So Microsoft have to be in there. They're a tech company.
No, they're in the attack number 11.
They're an attacker.
Yeah.
Let's go with
Think American, 2 American, 1 Swedish.
2 American, 1 Swedish. So Swedish, I'm going to go with.
Take a gamble.
I'm going to go with Assa Abloy.
No. Evolution AB.
I was going to say Evolution, but I didn't think you put them in there.
Yeah. So what do you do at midtime?
At midtime.
Yeah. You take coffee. You go to Starbucks.
Starbucks. Okay.
Yeah. And the others they take a Coke. So this Pepsi.
PepsiCo.
Yeah, and then we still need one attacker. It's a low yielder, but already for over a decade with around 15 to 16% average dividend growth.
Visa.
Yes, exactly. How do you like about it? It's nice, right, to build a portfolio like that?
That's very good. Yeah, very good. We need
need
to get some subs there that sit on our bench ready to come in.
Yeah, he says he has 33 stocks, so he could have a first team, a second team, and a third team in theory. I really liked it. It was really creative. It was nice to see. Got a lot of appraisal on Facebook. So thank you for sharing. Very creative. It was nice.
Good. So speaking of which, let's talk about dividend hikes, dividend announcements, which we love. Legal and General hiked their dividend by 5%. Remember, this is already a high yielder. This is
yes,
a 9 or 10% dividend yield, and you hit a 5% hike. Quite incredible.
Yeah. Do you own some?
Yes, I do.
Yeah, me too.
I do. And we say this, I think that we must be saying this quite a lot over the last 12 months, but it just seems these insurance stocks are continuously undervalued, and it's so hard not to keep buying them. It is really hard. I'll just be full of insurance if I keep going. European Dividend Aristocrat, also on your Noble 30 index, is the Spearex Group, and they hiked their dividend by 3%. To 165 pence per share, which I think is pretty in line with how they're doing at the moment.
What do you feel about them? Because it's 3% is low, but also their earnings growth was kind of poor.
Yeah,
why pay such a multiple for it, right?
It's quite low. The yield is quite low. They are in a bit of a moment where industrial production is under pressure, and we see that in a lot of industrial types of companies. But they manage it quite well. I'm hoping that they drop
more,
2.5% yield, and I'll definitely be buying them. But theme is one of those areas that, I mean, we use in our place. It's intrinsically safe. It's one of the best methods to use for energy. I really like the company, but I'm waiting for a proper valuation. I can't buy them at a low yield, but Watson Marlow's are obviously good as well. So keep an eye out for them. Henkel increased the dividend by 10%, 10.4 to €2.
Yeah, and that was an outlier. They had like kind of flat dividend growth for a few years, like not going anywhere, and then suddenly a 10% bump. Really impressive.
Yeah. Munch Own Machine, ticker symbol MUM, hiked its dividend by 12%. They announced this back in February, I think, but quite a nice hike. Also, I own maybe 50, 60 shares of those as well. And then the final company is Rheinmetall, raises their dividend by 42% to €8.10 per share.
I mean, you've seen the share price of this one.
Yeah.
I mean, with all the wars going on, no surprise. It's on
I,
fire.
I mean, if you could go back in time, you would probably start buying defense stocks in 2020 in COVID.
If I could go back in time, I would buy Bitcoin in 2011.
And we'd never have a podcast. We'd be on YouTube just shilling crypto all the time.
Oh, yeah. And then doing a rug pull somewhere.
Yeah. Some nice dividend hikes there, I have to say. I own two of those companies, Legal and General and Munch Own Machines. So I'm doing quite well with dividend hikes this year.
This year has been excellent, really, Derek. So, I mean, so nice. Like all of them.
Yeah.
It's amazing. Yeah. And then, man, those insurance motherfuckers. It's almost a wet dream, right? The insurance companies over the last 2 years, like the opportunity that we've been given. And if you now look at the solvency ratios, all at 200 or above 200, and I mean,
as strong as they've ever been.
Yeah, that's how it feels like. And then still many of them have like an about 5% yield, growing with 5% or more. I mean, there are not many companies that offer this kind of starting yield plus growth plus risk and reward in terms of valuation. It's almost like you think like, what am I not seeing in this sector?
Yeah. That's the problem. And I just mentioned it. I could keep buying it, but you also have that little thing in the back of your head. You're overextended. You have too much.
Exactly.
Diversify.
Yeah.
Then on the other shoulder, you have, come on, man. Come on.
Yeah.
X% yield, 5% growth. Buy more.
Exactly. It's also like a little angel and a little devil on both shoulders.
Yeah. But luckily, we're in a market correction, and we're going to speak about that, which might give us more opportunity to buy some. Actually, the top quality companies we speak about have a discounted price. But I mean, the last couple of weeks, especially maybe 2 weeks, the market has been nosediving, and I seen you put a post on it about it on Facebook. But what do you think is, I mean, we spoke about this over the last few years. We've had so many catalysts, or what we thought would be a catalyst, such as the war in Ukraine we thought might help, and none of that seemed to affect the market. And here we are all of a sudden, Trump comes in, everything is good again, and the market is nosediving.
Yeah. I mean, politics, yeah, what can I say? Look, I think there are a lot of things going on. Yeah, and I don't think it's just tariffs.
Yeah.
I think tariffs is probably the trigger point for it. But come on, you can't, if you have seen how the multiple of the S&P and S&P 500, the earnings multiple has been going up, and up, it was about time to blow off some steam, with this Max 7. So I think this was also this is also part of it. Tariffs, of course, don't help in the whole sentiment. Yeah, but let's also not forget that Germany was already stagnating quite a bit. Yeah, the U.S. debt, it's really becoming serious. So sometimes I have this feeling that the U.S. is trying to just bring it synthetically into a recession so that they lower the interest rates so that the debt burden becomes more bearable. Yeah, I don't know, but look, you use the term correction, but you can only use the term correction if, let's say, the S&P 500 dropped 10%, and that's what it did yesterday. So for me, this is really like, I mean, I feel like so happy with that. And I put it also on Facebook. I really think, and I really came to the conclusion that we are a different breed.
Yes.
If I'm looking at people that I know that are investing and talking to them, I see scare in their eyes. And I just feel pure joy. I feel like it is, you remember when you were a child and it was like, 25 December, you go down, you know that the presents are already somewhere there.
Yeah.
But you just know you can't unpack them yet. You need to wait for the big day. For me, this feeling that I have, I need to wait for my salary, and then I can, and then I can unpack some presents again. But I really have this inner child joy in me at this moment in time, and it's stupid because the stock market is trading where it was trading last August. Yeah, so to some extent it's stupid, but it's not a stock market; it's a market of stocks. We'll talk later about a few stocks also with the listeners' questions as such, where you can clearly see that they went even farther than 10% over the last few weeks. So it's Christmas candy store. Christmas came really early this year.
Yeah. But imagine you're a growth investor and you have all your money in Tesla, and you look at your chart now and it's down what 25% over the
Yeah.
last week. That must be tough to take. It has to be tough. Even though it's at the same price as it was last August, just that
Yeah.
psychology of looking at your portfolio. See, like it's okay for us. We're going to get a dividend at the end of the day.
Yeah.
They are just on price.
Yeah. It all depends on where you buy. If you bought Tesla and Palantir, let's say if you bought Palantir at 12 euros or 20 euros, you think like, I still made, I don't know, 60 euros, $60 profit. I think the psychology starts changing when it turns into red numbers in your portfolio. I often see that if people, let's say they bought, I don't know, Tesla at 50 and it went to 100 and it drops to 75, they feel like, I still made 25 profit. Yeah. So it really depends on where people started to invest, I think. But it must be hard, specifically to your point, when you're only in it for the value.
Yeah. See, I don't think I'd be like that. I think if I saw it, even if I'm in the green, but I know it's dropped 30%, I would be looking at back on, oh my God, I should have sold this 2 days ago. I should have sold this last week. I'd have 30% more.
Yeah.
That's how I feel like I would react to something like this, which is why I don't follow that path, because my emotions would 100% control my investments if I was to go down that route.
Yeah.
Which is quite interesting, I think. But I mean, in the end, everybody becomes a dividend investor, and I seen you say that to someone recently, and I think it's true because, I mean, I look at the Mag 7 there, and it's gone down so much. I know it goes up over time, and over the last 10 years, it's been good. But what if we have a decade like the last decade in the US market, and it just continually go down and drops in value for 10 years? I don't think I could physically handle that.
Yeah, but it depends on, again, it's a market of stocks. So it rather depends on whether, for instance, Nvidia is the next Cisco.
Yeah.
Cisco is always used as an example of 2001.
It's a very good
where it went nowhere the last decade. Even Microsoft had the same. So that's really the question here. And it may sound really awkward to call Nvidia the next Cisco, and I actually have no claim to make. But from what I understood at that time, Cisco was also seen as like going to change the world. The internet is up and coming. They have everything, the networks, the routers, everything. Yeah, Nvidia is the same now, right? But yeah, I'm not literate in Nvidia. I've not studied their demand cycle and everything. But if you look at the multiples, a lot is priced in. A lot of expectation is priced in, right? So yeah, just give me the boring dividend stocks. Yeah, they will underperform probably from a total return point of view in a bull market and outperform in a bear market, or what we are seeing now. I mean, over time, it means we'll probably miss out on a bit of total return from that point of view, but dividend-wise, that's what I care about. That's the only thing. I mean, we had this in our script here, right? When we prepare always in the show notes. I mean, look at this. The color is so nice. Everything is red, but then you see in green, Berkshire Hathaway. It's so funny, right? Like this little hawk, right? This Buffett there, sitting there on a 350 billion pile of cash. Really like this from Donald Duck, this rich guy, like just swimming in it.
Up 9% when the whole market is down. Just printing money. But then look at some of the other companies that are green. We have AbbVie,
Yeah,
Verizon, AT&T. We have what else have we got there? XOM. Johnson is green.
They said it was a rotation into dividend stocks, and I felt like, oh no, please don't do this. I want my dividend stocks also to go down. Please don't let them go up. Yeah, I also want to benefit from cheaper prices.
Yeah, but there's definitely some consumer staples, Home Depot, Target, all these type of companies are falling. So there's lots of opportunities. Don't worry, not all dividend stocks are going up.
Yeah,
you're okay. But do you think this is going to lead to like a broader economic problem? Like, will it be long term, or like corrections usually are over?
Yeah.
before you get paid. So you're going to be waiting.
Yeah, again, if I would have known that, I would have also positioned myself like that by going short the whole stock market. If I would know that we would drop another 10%, I would probably refinance my house and put everything on like shorting the Nasdaq. So of course I don't know. I really don't know. Yeah, look at how quickly COVID bounced back, like in a matter of 1-2 months.
Yeah.
I really don't know. What I can tell you is that this is called a correction. A correction happens usually 2-3 times a year. Yeah. This is not something called yet a bear market. A bear market is when the share price drops 20%. Yeah. And usually it's a prolonged period of significant decline. Yeah. Usually recessions are going on and such. We are still not there. And I also don't know if we go there. I have a feeling that a lot of this, what I mentioned, was triggered by the tariffs. If this calms down, I wouldn't be surprised if we're quickly again back at where we were, and we will be talking here on the show like, oh, I wish I bought more in early March.
Yeah. Yeah.
Yeah, I don't have a feeling that, yes, there are some things like cooling off, like I mentioned, but I don't have a feeling that the entire American economy is in a recession mode or something like that. To the contrary, if we studied all the reports, all our companies from the US were quite healthy. Yeah.
Yeah.
So I don't have a feeling that there was something underlying economically. I feel more that this is because of the trade war and everything, and this that triggered the a little bit of an overheated Max 7 and such. Yeah, rather than that there's something fundamental there.
Yeah.
But it can trigger now into something, right? If sentiment goes down, maybe people become more conservative. They are firing by the bushes people in America and the government. So maybe it will be an engineered recession or something like that. But yeah.
Yeah. Like sentiment can take over quite quickly, especially with the narrative around
Yes.
Russia is still there, Ukraine is still there, tariffs on every single country in the world. So it's not unimaginable that we could see a bear market as a result of this.
There's a perfect storm. Yeah. It could. There are many arguments to be made that it could be.
Yeah. I personally hope it does.
Yeah, me too.
I hope it does.
Oh boy, yeah, I feel poor for all the people that will be impacted by that, and God knows, maybe ourselves as well, right? But, well, and maybe an incentive to retire even quicker.
Yeah, yeah. And actually, you think about that, people with their pensions and coming out of the market, it must be quite scary if you're coming out with a pension that's in equities and you see it drop 20% in a week. That must be quite scary, but I'm not there yet, so I have to not worry about that.
Exactly.
But one question: have you bought anything? I know you said you're waiting to get paid, but have you?
Yes, of course. I was buying. I mean, I burned all my cash early this week and last week, I believe. Yeah. Consumer staple, of course. We'll talk about that maybe a bit later. Yeah. I've been buying. You too?
Yes. I bought an Irish company. I bought Glanbia.
Okay. So you went into what is it? The proteins?
Proteins, yes, proteins. I did a deep dive on them, and they were trading at around 17.
Yeah.
And I had said that once they get around 12, I would be more interested. And they were around 12.50, so I said, I'll just ease my way back into this.
Yeah. Oh, nice. Yeah, I mean, what you see now, for instance, right? You're talking about Glanbia, yeah, but for instance, technology is clear, and consumer discretionary as well. The cyclical, they went really down. So, for the technology sector, went almost 11% down. Consumer discretionary, like where the Disneys are and such, right? They went down with almost 14%. But then you see consumer staples down 2.5%, healthcare down 1.7%. Yeah, so it's clear where the thing is, and real estate really held up. I was really hoping that, for instance, Sila would drop quite significantly. Just nothing. I mean, here I'm looking at the picture. The whole real estate sector went down just 1.4%, and the last times when there was a correction, they were all the time like pulling everything down, right? But this time they're really holding up well.
Yeah, Yeah, but the narrative the last time was around interest rates. That
Yeah.
narrative is not quite there. But you spoke of consumer staples. Have you looked at Target's earnings? We got a couple of questions from Joe Roerings and Ekrieve about them. I mean, they keep dropping in price. They're so
Yeah.
tempting for me as well.
Yeah, so I can already say I bought some Target, of course. I bought it too early at $115, but hey, it's now at $105. Maybe I'll buy more at $100. I don't know. Yeah, I looked at it. For me, what is we spoke about last week about Target, right? What kind of store it is and such. What people need to know is that generally speaking, the earnings did go down by 1% in 2024 compared to 2023. Actually, the fourth quarter earnings were quite poor. They were like 241 versus 298 the year before. The company does use the excuse that there were 13 weeks in the quarter in 2023, citing 1.7 billion of net sales difference. Yeah, it's a bit bullshit. Of course, we know that. Yeah, because they usually they generate around 1.5 billion or something like that. Is it 1.5 billion? No, like 2.5 billion per month. Of course, Christmas season and everything. But yeah, if you take the last week of the year, yeah, it will always be our highest. So I mean, come on, I mean, they try it, yeah, but they really have not met European people yet that think like, yeah, shite, don't bullshit us. Yeah.
We can do maths.
Yeah, exactly.
We can subtract, divide, and multiply. It's okay.
Exactly. Yeah, but at least we went to school here in Europe. No, I'm kidding. But if you then look at the dividend is 4.46. They did a 2% hike last year. So it because also what you need to know, I think 1 or 2 years ago they had a really huge hike target, right? So it's no surprise that they are a little bit more like keeping it down now, but it's still like a 60% payout ratio or something like that. So if I look at Target, I think it looks really attractive. It is a dividend king with more than 50 years of dividend hikes. I once analyzed the company. I mean, it is a little bit on the woke spectrum, but I mean, they're just generally a well-run company. Yeah.
Yeah.
So yeah, you could buy that $260 in 2021, 2022, or you can buy it now for $105. I mean, I'll give it to you. Yeah. What's the yield now? 4.3%, something like that.
Just over 4%, if I remember. Yeah.
Yeah, and I think it's a company that will do 5 to 6% annual growth if you zoom out over the next decade. So you get kind of a 9-10 chowder roll on this one, which I think is quite decent for a consumer staple like this.
Yeah, they're definitely one of the more attractive ones, and I love how I know you said they were a little bit woke, which at the time I was not a fan of, but they do always try and innovating and at least
Exactly
stay up with the times, and it probably what separates them from Walmart, in my opinion, is they have that little bit of an edge there. Online retail is starting to take off a little bit for them, so.
Yeah, but Target is more cyclical than more Walmart. Yeah, because of the TVs and everything, what you can buy at Target. Walmart is really more, I would say, stable from that point of view. Target is known as the more cyclical consumer staple. So no surprise also that it crashes a bit harder.
Yeah, of course. But then some of their margins are better because they're in other higher margins. So there's pros and cons to both, but I mean, if it gets under 100, it's definitely going to be too hard to ignore, I would say.
Yeah.
So
yeah, I would agree.
Let's see. But what about then someone like T. Rowe Price? So Lucian has asked us about Rowe. I mean,
yeah, this is an interesting one, T. Rowe Price.
Yeah.
Because let's face it, I think we both have it in our portfolios.
Yep.
That has been dead money from a total, from a share price point of view. And why it has been dead money? Because I guess at the time that we started buying there were more net outflows than inflows. And the company started to struggle a little bit with the actively managed funds, right? So both retail investors and institutional investors started to take money out effectively. Yeah. Which is also probably why the price is now in the low 90s. Yeah, and it hasn't been there for a very, very, very long time. So yeah, I wouldn't be surprised. I don't have a chart in front of me, but I wouldn't be surprised if it's like a decade low or something like that. But again, they have no long-term debt. They have a pristine balance sheet from that point of view. They grew their EPS and their revenues in 2024 because the asset under management was growing. Why was it growing? Because the overall stock markets went up by 20%. And if you take a fee based on the assets under management, yeah, no wonder that it grows. So what are we talking about? A 45% payout ratio. Good news though, in 2024, the net outflows were less, almost half of what they were in 2023. The company really started to turn this a bit around. They launched ETFs as well. Those ETFs are seeing good net inflows. So I think this is just kind of a wake-up call for them to start offering some products that are maybe more up to date with 2025. I hear a lot of people being very pessimistic about T. Rowe Price.
Yeah.
Like everyone would just pull the money out because it's fund managed. But I don't believe that. What I see is that when you have like specifically in Europe, so maybe that's where I'm wrong, but most people, and we talk about it, most people, they feel like it's safer to save money than to invest.
Yes.
So when a company offers a pension plan, they just blindly sign up. And their money goes in there by the employer. The employer doesn't really have an incentive to give you performance. They just want to know that it is at a company like T. Rowe Price and that the money of their employees is stored well there, that the company is not going bust, that the company has trustworthy management, decent performance. So companies like that, those corporates, they don't take it lightly to just change the pension plan or something like that for their employees. So there's a lot of like passive money in there, and not from an ETF point of view, but just like passive money because the employees don't know what to do with investment. Yeah, it goes in there passively. So I don't see strong incentives for those companies also to switch. Yeah, and that's the reason why I think, to me, it's a story like with Apfi, with the patent cliff. Like, oh, everyone will pull out biosimilars and this, and look at how much time they had and how much time they had to improve the pipeline. This is what I see with T. Rowe Price as well. It's a very slow compounder. We know what's happening there with the inflows, but this company started having net outflows in 2020. It's the 5th year, and after 4 years, they started already reducing significantly the outflows. They have another 5 to 10 years to do some acquisitions, to really get better with the ETFs, to make sure that the margins are good enough. So I mean, and then you get it also now at a, I don't know, a 5% yield or something like that. So at a zero debt balance sheet, they have enough money to do still acquisitions, and if they are fine with their portfolio, they could really turn the buyback machines on.
Yeah. It's one of those companies, it feels almost like Danone in terms of dead money when the share price wasn't growing and the dividend was pretty much not growing. But Danone didn't have a no debt on their balance sheet. I mean,
Exactly.
balance sheet is super strong. And actually, if you zoom out on the share price, it did dip below 90 in 2020, as you probably expect. The last time was 2018. But if you go back as far as 2006, the share price has constantly gone up and down in these kind of waveforms. So it's not unlike them to be like this. And
and the question is, why do they have zero debt on the balance sheet?
Because management have worked really, really hard to keep it that way.
Yeah, and they know what the risk is of their company.
Yeah.
So they have not attracted themselves or lured themselves into buying back shares based on debt. They didn't join the bandwagon there like all the other corporates almost did, like the IBMs of this world. They didn't.
Yeah.
They just kept a clean balance sheet so that they are future-proof. They probably saw that the market at some point in time may start shifting. So they do have enough money on the balance sheet with that to do some acquisitions. Also, they mentioned in the latest earnings again, they prioritize dividends and then mergers and acquisitions and such. So yeah, for me, this is more like a risk reward story. Yeah, I wouldn't say you buy it now for the strong dividend growth. It may be another dead money for 3-4 years. It's more like a risk reward. So here comes a little bit like valuation, and if
Yeah.
it is in the low 90s at this yield, no debt, what is it, 10% earnings yield, something like that.
Yeah.
Then you need to ask yourself, do I want to have this from a dividend point of view, or am I now the value investor?
Yeah. Like, to be clear, I don't think I would buy them right now. We talk about opportunity cost. I would struggle to buy them right now, especially because they still have outflows. The dividend growth is like token dividend growth at the moment.
Yeah.
However, as I am already invested in them, they haven't given me a signal to sell them. And it's the one thing I've learned, or trying to learn, I suppose, is they haven't yet given me a signal to sell them. So I'm holding tight. I'm ignoring all the noise for now and holding them for the long term, and we'll see how it pans out.
For me, it's really simple. It's a tier 4 company. It's maxed out.
Yeah. And I have a nice yield, and
and my rules are in place, so I shouldn't buy more. It doesn't deserve to go to tier 3. It doesn't show that strength, so it stays there. Yeah, and even though the price looks appealing, my rules prevent me from buying it.
Yeah. Okay, so that's pretty much most of what we have to say about stock market corrections. I don't think it changes our course whatsoever. Long-term investors and buy more.
I'm just annoyed that I don't have more money.
Yeah, I feel like I was better prepared in 2020. I had a little war chest that I could buy more. That's sucked up now. So let's hope for like a 5-year long bear market that we could just
5 years would be good. I think if we then get a lot of 4 and 5% yielders, it will get me closer to early retirement. That would be nice.
Yeah,
but they should continue growing the dividends, of course. Yeah, the underlying growth should be good, but then we're more looking at multiple contraction.
Exactly. Fundamentals are good.
Yeah,
but it's just market sentiment driving it down. That's all we're looking for. Not looking for a lot. That's it. We move on to some listeners' questions. Seems we looked at some companies, and Dividend Controller has asked us about words of wisdom that we followed at the start of our investment journey, but we now think is bullcrap.
Yeah, in the beginning, I was a fan of having a war chest. That's such a bullshit.
Yeah, buy the dip was one. Remember, buy the dip was actually one of our kind of meme things in 2020. Because something it dipped like 0.3% and you're buying it because it dipped. It was red.
Exactly. No. I had a war chest in the beginning. Let's say 10K in there, but since then the stock market went only up, probably doubled. So it's for me it's bullshit unless you can time the market. But then, so we have now 10% correction. We're trading at August 2024. I had my war chest in 2020. 2019. So, look at where the stock market is now. It doubled.
And
you get a 10% correction. Was now then the time to do the war chest?
Yeah. And I don't even think it's having the war chest specifically, but the sentiment around most of those times was that the stock market was going to crash. Remember 2018, 2020 it did to a certain extent. Even in 2022, there's always been a rhetoric that the stock market is going to crash. I'm going to keep some money on the side, and when it crashes, that's when I'm going to get in.
Yeah.
And it never crashes. And then we have this 10% drop that's a correction now. But as you pointed out, we're only back to where we were last August. So
exactly. No, but that's sometimes I'm thinking, okay, but what then? How can you make use of an opportunity? First of all, it's good that we count easily. But imagine that we get now a 2009, 2010 situation. The stock market dropped 50%. Everyone is screaming hell, Great Depression. These terms are being used. And you see just fundamentally that some of the companies are just doing well. Would you take on margin or go to the bank to refinance your mortgage, let's say, and buy as much as you can? Would you do it?
No, I'm too risk adverse for that. But we did have
Cameron Stewart on there.
Cameron Stewart did that. Yeah. He was brave enough to do that.
Yeah.
I don't think I would be. Actually, I know I wouldn't be. I would not be.
I don't know. I really wonder. I've never experienced a 50% drawdown as an investor, on this journey.
I think if I was single, living on my own, and it was just me going to be affected,
Yeah.
I could see myself do it, but
Yeah.
I could not see myself taking out a loan on margin, knowing that it can impact my family.
Yeah.
That's probably where I would not do it. But again, I'm a dividend growth investor. I'm not the most risk person out there.
Yeah.
To be honest.
I wish I was like the government, that I would just be able to spend other people's money for my own benefit.
Then I take out margin.
Yeah, exactly.
Just as well, I'm not an investment fund manager. I'd be geared up to the eyeballs on that. The Stock King has said stocks and crypto are bleeding. I'm surprised crypto is bleeding because it's a store of value.
Yeah.
But stocks and crypto are bleeding. Any material stocks finally back to shine. Gold is up and silver is up.
I have no clue. I don't look at all this kind of stuff.
Yeah. Typically they say though, if the stock market is declining, that you should be in those types of assets.
Let's say like that. Bitcoin doesn't pay me a dividend. Gold doesn't pay me a dividend, and silver doesn't pay me a dividend.
Yeah, but you can buy ETFs. You can buy some things that may in those sectors. Mining companies, for example, are one.
Yeah.
But you don't own them either. Yeah. I think I know they're up at the moment, but I always feel like it's too late if to ask the question when they're on the way up. Usually, you want to be buying them when they're.
I feel like you need to be a perma bear to buy gold.
Yeah.
Like I mean, probably smart investors, they have 1% gold in their portfolio on when everything is like smooth sailing, and then turn into 1.5%, 2% now. Yeah. But you need to be a perma bear, I think, to really think all the time about gold. Or you need to be a trader. I mean, there's a guy called Sippy Silver on Twitter, a guy that lives in Finland. This is all he does around silver and gold, but he understands this stuff, and he makes money out of this. But yeah, we chose the dividend growth investment strategy. So for me to start studying that and make it my whole circle of competence is not something that I'm.
But I feel like when equities are at an all-time high and everybody is so bullish, buy gold, buy silver, because they'll probably be dropping. And
but we have seen the last 10 years that the stock market is on an all-time high, like 200 days a year.
Yeah, true.
Yeah.
True.
Yeah.
Yes,
that means like 200 times a year you would be buying gold or silver.
Yeah, exactly. You'd be dripping in gold.
Exactly.
Yeah, but what do we know? That's not.
It's not a circle of competence.
Sebastian has asked us if we buy a new stock in our portfolio in January, and its first dividend will be paid in April, but it hikes its dividend in March. Do you count that as a dividend hike or not?
I love this question, Sebastian. I can hear it already. You're very analytical, and you're a dividend growth purist, and you're wondering what to do with your organic growth formula in your G sheet. I love it. I mean, I don't know. I don't know if there's a rule for it even. So I would probably just count it as dividend growth. Yeah.
I'm taking that all day long. I'm counting.
Yeah, you need to take the small wins.
I'm counting that. My yield on cost has gone up. That's what I would.
Exactly. But I love the question. The detail in it is it's amazing.
And the second question from Sebastian is, what are you adding to your portfolio, and why is it Novo Nordisk?
Yeah, I've been looking at Novo Nordisk, but I've not added it yet. I have quite some pharma in my portfolio. I like Novo Nordisk a lot, but then also if the latest trial that they were doing, where they were only having 15% weight loss, while Eli Lilly has 20%. I think, I mean, the dividend safe, that's no brainer, but for me there's too much risk on a single business line, and I see that I'm shying away from that. But of course, all our Danish listeners, they are like probably loading up the truck right now around Novo Nordisk, but there's still something blocking me from buying it. Maybe they need to reach out to me and convince me. Otherwise, I did a deep dive article on it.
Yeah.
So I know that the dividend is safe and everything. It's very clear. They're the first mover in this industry. They have a really strong pipeline in this industry as well. The industry is the total addressable market is growing so fast. I mean, there's so many fat people in the world. It's like unheard of. There's like almost an unlimited supply of fat people. So it's more like, can they produce enough? I'm sorry.
I'm sorry, I should have out myself. I was not expecting you to say that.
Yeah, sorry. I'm saying it maybe without the heart, let's say, but I just looking at from a business point of view.
Yeah.
Yeah. And sorry for anyone. I'm not trying to fat shame anyone. Yeah. Can you help me getting out of this situation here?
Yes. Yes. I think what you're trying to say is you did a deep dive, but you don't have 100% conviction that they are at the right price.
But no, the right price, the dividend safe. It is like I think 2 or 3 times in a row bad news about the pipeline here, where it actually strengthens Eli Lilly, which makes me, yeah, I don't know, it doesn't give me the right vibe. Let's say it like that. Yeah.
Fire engineer has asked, do you have a predetermined kill criteria for your holdings? For example, if Diageo stop making beverages.
Yeah, I would say so. We experienced that a little bit with Viatris, right?
Yes. Viatris sold
The biosimilars business.
biosimilars, which was actually the part I was the most bullish on.
Interesting. Yeah, exactly.
But let's take Diageo as an example. If they sell Guinness, I'm out. Well, I don't own them, but I would never even.
But they want to
Yes,
sell
they
Guinness, right?
want to sell Guinness. Yeah, I heard that.
Why would they do that?
I don't know. There may be a reason. I don't know if it's growing or not growing, or maybe people in Ireland are only drinking Heineken these days. We're going Dutch. Who knows?
Yeah, I mean, I don't understand it. Anyway, yes, obvious. If for instance, Coca-Cola stops producing cola, yeah.
But I mean, for each company you own, you have to understand the risks and the type of scenario that you would sell in.
Yeah.
And I think something like Diageo, which is a good example, if they were to stop making maybe alcoholic beverages in general and focus more on, say, soft beverages, I would probably sell them, because that's completely gone away from what they're used to.
Yeah, true.
Actually, next question from one is a good question. Speaking of what we were talking about earlier about going to the bank and taking out a loan if you had a 50% drop in the market, right? So thinking about that, with their current broker, they have the opportunity to borrow up to 10% of their portfolio value at a 2% interest rate, 25% at 3%, and up to 50% at 4%. What about investing that into stocks like Shell, Johnson & Johnson, Coca-Cola? The debt would pay for itself.
Yeah, this is a little bit what you do with real estate, right? You buy real estate on leverage and then use the cash flow to pay the interest on your mortgage. This is effectively the same. Yeah, it only works as long as those companies pay a higher dividend.
Yeah, I mean, look, Realty Income, the monthly dividend paying company, it's never not going to pay a dividend. It's their slogan, 5.6% yield.
Yeah.
If you take out 50%, you're still left with a 2% yield.
Yeah.
Before tax.
Yeah.
I would say. So it's
technically it
the money
margin. Yeah, you could argue, but no, I'm debt averse.
Yeah, I'm the same with you. That 10% of your portfolio value would tempt me, definitely more than 50%.
But this would be more for me the case, like if I would like to buy tomorrow because there's the opportunity that I can't miss out on because something happens. I know it's temporarily. I could go into margin knowing that my salary comes next month, and I would just borrow my salary forward 1 month. I could imagine that, but not even more than 1 month.
Yeah,
just knowing that in 2 weeks I just refill it and I'm zero again.
But maybe, for example, let's say take 10% of your portfolio. If you are planning on investing that over the next 12 months, and you're doing that monthly, because we're monthly investors, the market's after dropping now, and you see a good opportunity to invest a year in advance at a good price, and you
Yeah.
think the market's going to go up like in 2020, it might make sense to do that because you're going to be paying that money monthly anyway.
Yeah.
You're just doing it in advance for 1 year rather than spreading it out over 12 months.
Yeah, well, there's a reason why I'm not having real estate with tenants, and that's because I don't like the debt. And this is the same. I mean, Juan, yes, the math works out
Yes.
until it doesn't.
Yes, the math is working out, but again, I don't know the terms and conditions of this borrowing. That's the key there.
Yeah, but what if, for instance, suddenly realty income is in the blast zone and the dividend gets cut? There you are.
Yeah, it's good.
Yeah.
What if? But yeah, look, Matt's are holding up on this one. It's it.
Yeah.
It would make me think. It would make me think of it. I would say.
Yeah, but you have this in you. You like speculation. You like gambling.
Sometimes, but then, as I said earlier, when it comes to risking a lot of money, if it impacts my family, then
Yeah.
that's where I draw the line. I don't mind if it impacts me, and I think I could. My portfolio is relatively low, so you're looking at 100K. I'm only looking at 10,000 here, so
Yeah.
I could soak that up in some way or form. 50% is 50K, not so much. So I've never gone to that extreme. That's where
I see.
the next, I would like actually you to pronounce this name. It's an Irish name, and you make fun of me all the time with all these names.
Mark Omol Domhei.
Close, but we'll say Mark.
So how do you pronounce it then?
It is a tough one. I would say Mark O. Malinoev.
So you don't even pronounce the letters.
You do? Just
Say it again then.
Malinoev.
But it says Mol Dom Hanai.
I could be saying that wrong because Irish is quite tricky. But I should send you on a video. There's a video online about Irish names. There's a whole host of them, like Saoirse and all this. And anyone not from Ireland trying to pronounce them, it's hilarious. It's actually hilarious. I'll send that on to you. But Mark is asking us about handling the current volatility in the market. Are some of your holdings affected by the proposed current tariffs? And if so, are you doing anything to mitigate against this?
No, actually not. I mean, if you look at where the tariffs are, it's on steel, it's on all these kinds of things. So, and if I look at what is in my portfolio, it's kind of all free of those tariffs. So, no, I mean, I'm not investing in car manufacturers, as example. I'm not investing in steel producers. So I have it quite easy from a tariff point of view.
Yeah, I'm quite similar. And then what are your thoughts on European defense stocks?
Yeah, too late for me. But I do think that British BAE Systems still looks quite okay. I would need to understand a little bit their product portfolio. I understood yesterday the leader of the NATO, Mark Rutte, the Dutch guy, he was at Trump, and he was mentioning that the majority of the spend is still going to the American defense contractors because they just have the superior technology. So I'm actually thinking that if you hear that, it seems to be that a lot of money will be flowing there.
Yeah. They do the airplanes, the Typhoon airplanes, I think, and America is a big part of their market as well. I think that's why some of the other European companies have done much better because they're more concentrated within Europe. But I'm with you, BAE Systems do look interesting. Yeah. Tim has asked us, did you get any further in writing up your portfolio handover strategy to pass on to your kids?
So not yet. I mean, it's like 60-70% done, but now I need to get back to it. Funny is asking it because I was thinking about this morning, like because it's on my to-do list. I see it all the time, feeling like, okay, I need to finish it. I was really making great progress on that for 2-3 days, and then
life.
Yeah, exactly.
Christoph has asked us, I would be super interested in your opinion on the results of Legal and General.
For me, they were quite okay. I mean, this company is making quite some portfolio changes as well. That's also why they are announcing massive buybacks and such. But management just seems to be really good. They're committed to dividend. Dividend will slow down a little bit, dividend growth. So is the buy? I mean, I don't give this kind of advice, but I don't see anything very bearish either. Let's call it like that.
Yeah. I don't think the buybacks are a surprise when they sold that part of their business
Exactly.
a couple of weeks ago.
But they get to retire shares at a 8, 9, 10% yield.
It's
So it's
crazy.
a high cost of capital. Yeah. So they can keep those dividends in the pocket as well.
Yeah, it's crazy. It's crazy. Yeah. I'm tempted to buy. There's so many companies I want to buy.
Yeah.
Christian has asked us our opinion on Lowe's. Recently, the stock came back significantly and the key figures look great. We're back to over a 2% dividend yield and the payout ratio on free cash flow is only 33%. And remember, they have a 63% history and an 18% 5-year dividend growth rate.
Yeah, I mean it's a really nice business, just right. It's kind of probably the ugly little brother of Home Depot, because Home Depot gets all the shine. It's like the queen on the proms, right? And then you have this ugly nerd with the big glasses is Lowe's. Yeah, but it doesn't make it less attractive from an investment point of view.
Yeah, it's hard to argue with that your dividend growth of 18%, but still a 2% dividend yield is just, I don't know, it's too low for me.
Yeah, that you could also look at the earnings yield. Then it means that this company, if it's a 2% dividend yield, 33% payout, that is a 6% earnings yield. Yeah, and what is it? A 16 multiple then? I think, yeah, inverted, it's a 16 multiple, I believe.
Yeah.
It's not too bad for such a company. And if it has such a strong dividend growth, then it could be quickly 4%. Yeah.
And then the last question of the day goes to Mayak, and he's asking, which technology stocks with a growing dividend do you consider as worth looking at?
Google,
of course. I'm going to go up and a company we mentioned earlier, Munch owned Machine. And I probably murdered that name in German, but I think it's a great company. I spoke about them before.
Yeah.
On this. Remember we were asked about Autodesk. I think that's what prompted me to look at them. So they were one of the resellers of Autodesk in Europe. They are reducing the reliance on that, and they have this custom software where the margins are extremely high. And the beauty of it is that it integrates into Autodesk, so you can still get the benefit of both from them. I think it's a good company to look at.
Awesome. I didn't expect that one.
Yeah,
that would say, yeah, nice.
Yeah, I had to do something different. Like, you can't always say Google and ASML or all these type of companies.
Good. I think we came to the end of the podcast. It is like 20 to 1 here. It's quiet outside. But we did it. We did it.
Thank you again for staying so late. I know it's quite hectic for you on Fridays, but we'll get this out early on Saturday. As always, thanks for the questions. Like us on Facebook. Please leave a review on Spotify, Apple, wherever you listen to this podcast. And we look forward to speaking to you all next week.